Hey everyone, Dan Johnson, Forward Thinking Wealth Management. I think this is episode 2 of the series of It's Not What You Make, It's What You Keep. So this week we're going to talk about tax loss harvesting, which is one of my favorite topics. So let's dive in. Tax loss harvesting. I know I've talked about it before, but I wanted to go a little bit deeper in this, especially because I have a nice shiny glass board here. Few key things. As a reminder, keeping it, even though we're going to go deep and keep it high level, I'm going quickly. So pay attention. First, what is tax loss harvesting? Simple example, you buy a stock or some sort of investment. I'm going to pick on GE in this case. You buy GE for $10 a share. Some time period later, it drops to $5 a share. You sell it and you grab that $5 loss and you use it to offset your taxes either in this year or in future years. Now, some keys to really do tax loss harvesting effectively. First, has to be year round. Can't just happen once a year. And please tell me you don't pay an advisor over 1% a year to meet one time and hope that they can do some tax loss harvesting in November. Why? Well, this year's a perfect example. We don't know where the year is going to end, but over the last few months, we've seen the market drop dramatically and then recover quickly. If you're waiting to meet with your advisor 6 months from now, that opportunity to take advantage of that tax loss is gone. Again, assuming the market stays at where it is or even goes higher. So has to happen year round. You've got to have an advisor you're meeting with frequently, talking to consistently, or have a management team behind the scenes doing it for you. Now, also, I love ETFs. Let's talk about ETFs and mutual funds in the world of tax loss harvesting. ETFs, the big advantage it has, it trades like a stock. So the example I'm going to use, Vanguard Large Cap ETF Fund. So in this case, we see days that unfortunately we have a lot of volatility where the markets drop 2, 3, 4%. It's not unusual anymore. So if you have VUG and all of a sudden you see it's dropped dramatically and you say, hey, it's 10 a.m., I want to sell it right now, you can do that with an ETF. If you have a mutual fund that's a large cap mutual fund and it's dropped 2 or 3% in the morning and you put in that sell order, it's not selling till the end of the day. Today's a perfect example. Market was down almost 500 points this morning. Last I looked, it's positive. So that mutual fund, even though you thought you were grabbing a little bit of a loss on that day, by the end of the day, that loss may be gone. That opportunity, window shut. Important. Wash sale rules. Basically here, 30 days. You buy or sell something, you can't or if you sell something for a loss, you can't buy that exact same stock back within 30 days. It's got to be over 30 days in order to preserve that tax loss harvesting. So, example again, GE, you sold it for that $5 loss and you say, oh, I love GE, I want to buy it right back, and you buy it 20 days later. Nope. IRS is going to negate that $5 loss that you had. So you did all that for naught. Example I use, what is good, an easy strategy. You could have 2 ETF companies and just set up yourself nice 2 investment menus for various asset classes. In this case, large cap asset class. VUG, Vanguard Fund, IVW, iShares Large Cap ETF Fund. So in this case, again, you sold VUG, maybe you bought it, and all of a sudden it's down 10, 20, 30%, whatever it may be. You say, I'm going to be smart. I'm going to grab those losses. I'm going to take the proceeds I have, and then I'm going to buy back into that. Why is this permitted? Well, it's a separate fund company, and these are not identical holdings. They're pretty close, but they're not identical. And this is a nice little loophole that the IRS has provided to us. Hopefully it stays open. So be aware of this. Now, the key with this is to do it effectively and to do it well. You need an investment team behind you. That's a full-time investment team. And honestly, I don't execute this on my own. I use a team called SEI. They do it behind the scenes. Why? They have full-time investment managers, investment team. This is all they do. They don't talk to clients. They don't go, meet with wholesalers over lunch to buy and sell products. They're focused on your accounts and to do this. And I know it sounds like a sales pitch, but I'm just explaining to you to do it properly, do it effectively, do it well. It takes a full-time dedicated staff that all they're doing is this. And what has SEI done? Well, over the years, they've added about 1% on annual returns just through effective tax management in a strategy. Again, the whole concept, now what you make, it's what you keep. So again, hopefully this is helpful. I know we've talked about tax loss harvesting. I know I'll talk about it more in the future. It's so key to, again, keep your taxes low, keep the returns going. As always, if you found this helpful, click subscribe on the YouTube channel. I always love more subscribers, and I'll see you back here next week with a little more content. Thanks so much.